Welcome back to Invest Smartly Hub, your trusted source for deep and timely insights into global markets. In this video, we take a closer look at the sudden and expected drop in gold prices following the surprising ceasefire agreement between Israel and Hamas, and we break down all the key factors now influencing the market. On Wednesday, gold surged to an all-time record high of $4,059 per ounce, driven by escalating conflict in the Middle East, a weakening US dollar, and growing speculation of interest rate cuts from the US Federal Reserve. But everything changed in the past few hours. A ceasefire deal was announced between Israel and Hamas, brokered by the United States, marking what could be the first stage of a broader peace plan for the Gaza region. This unexpected development calmed market fears and immediately shifted investor sentiment, especially for those who had rushed into gold as a safe haven. Gold prices have since pulled back, dropping 1.1% in the spot market to around $3,993 per ounce. U.S. gold futures for December delivery also fell 1.6% to about $4,006. The primary reason behind this reversal is the easing of geopolitical tensions. Gold typically rises during times of uncertainty, war, or crisis. But once peace is on the horizon, investor demand for safe assets like gold declines rapidly. Another major factor is the strength of the US dollar. The dollar index rose by 0.5%, hitting its highest level in 2 months. A stronger dollar makes gold more expensive for holders of other currencies, reducing global demand and putting downward pressure on prices. Additionally, after such a steep rally, many investors, especially short-term speculators, are locking in profits, which adds to selling pressure in the market. Meanwhile, the Federal Reserve September meeting minutes, released Wednesday, revealed that officials are still cautious about cutting interest rates further, despite recognizing growing risks to the labor market. While markets still expect 25 basis point cuts in both October and December, those expectations could shift if economic data remains strong or if inflation persists. Less aggressive rate cuts would mean weaker support for gold in the near term. From a psychological perspective, the recent breakout above $4,000 per ounce triggered a wave of FOMO, fear of missing out, among retail investors. But now, as prices begin to dip, we could see panic selling, where the same buyers rush to exit their positions, accelerating the downtrend. This emotional volatility plays a big role in short-term gold movements and could amplify any corrections in the coming hours. Meanwhile, silver prices have surged, rising 1.3% to $49.49 per ounce, and briefly crossing the $50 level, the highest in over a decade. This was driven by strong investment demand and ongoing supply constraints. However, if gold continues to fall, silver could lose momentum as well. Other precious metals like platinum and palladium have also dipped, with platinum falling 1.7% to $1,635.25, and palladium losing 1.2% to $1,431.58. So what's next for gold? If the ceasefire between Israel and Hamas holds and the geopolitical landscape remains stable, we may see gold test lower support levels, perhaps even below $3,950 in the short term. On the other hand, any breakdown of the truce, new regional escalations, or dovish shifts in central bank policies could bring gold back above $4,000 or even higher. Ultimately, this is a moment of high sensitivity in the markets, and any headline could cause sharp moves either way. In the world of investing, timing and insight are everything. At Invest Smartly Hub, we're committed to helping you make sense of the markets, spot opportunities, and avoid costly emotional decisions. If you found this analysis helpful, make sure to subscribe to our channel and hit the notification bell so you never miss an update. We have more smart forecasts, market breakdowns, and investing strategies coming your way very soon. Thanks for watching. Stay smart. Stay informed. And invest wisely, only on Invest Smart.